Is the Federal Reserve's latest rate cut a potential mistake that might lead us into a recession?
Absolutely. Today we're diving into insights from Bill Fleckenstein, who offers a critical perspective on the Fed's actions.
And alongside that, we'll explore the European economic fallout with Jeff Snider.
Plus, Jim Bullard shares his views on what the Fed should aim for in the future.
Welcome to Financial Insights in Minutes, where expert analyses are delivered succinctly.
Stay tuned as we unpack valuable insights about the shifting financial landscape and its implications for your investments.
But first, let's delve into what Jeff Snider predicts regarding Europe's economic struggles and their global implications. Let's dissect alarming economic trends showing how Europe may be dragging the world into a recession.
Our insightful guest, Jeff Snider, unpacks troubling evidence surrounding Europe's economic situation and its ripple effects on global markets.
What's the core thesis here?
The main thesis is that Europe's recession isn't just localized, it poses a significant threat to the U.S. based on concerning economic indicators and central bank reactions.
Let's break down some key points. What's happening with the rate cuts?
The European Central Bank is considering further rate cuts, highlighting deepening economic troubles, while the U.S. Federal Reserve's recent cut of 50 basis points is seen by many as a desperate measure due to serious economic concerns.
What does the manufacturing sector look like?
Great question. U.S. manufacturing has plummeted to a 15-month low, and the service sector is also under pressure, with companies bracing for substantial job cuts.
And how are central banks communicating?
The Fed and ECB are trying to underplay their rate cuts, attempting to reassure markets while acknowledging the dire economic reality, resulting in a credibility crisis.
What's happening to gold prices?
Gold has surged to over $2,600 an ounce. Investors are flocking to gold as a hedge against fears of a synchronized global recession.
What does the horizon look like for these economies?
The outlook is bleak. Continuous job losses in both manufacturing and services could potentially usher us into a full-blown recession by next year.
How about central banks' futures?
If pressures mount, expect more aggressive rate cuts ahead. However, such policy shifts could destabilize the economy even further.
What's our big takeaway from today's analysis?
The global economic outlook is increasingly concerning. Central banks face immense pressure, and their reactions may induce more panic than stability.
But wait, there's more. Next, we'll dive into insights from Nick Gerli on 40% inventory surge, striking fear in home sellers in more and more states.
You won't want to miss the insights Nick has about the current housing market trends.
Next, we're diving into the turbulent housing market with insights from Nick Gerli, founder of Reventure Consulting. A 40% inventory surge is shaking home sellers nationwide.
With the Fed's recent interest rate cuts, the dynamics within the housing market are rapidly changing. Nick's expertise will help us understand the implications for both buyers and sellers.
What's the core thesis about the inventory surge?
The thesis is that this surge in inventory, along with stagnant buyer demand, could shift seller psychology dramatically, potentially leading sellers to panic as they realize their expected home prices might not hold.
What insights does Nick provide regarding this inventory surge?
Nick highlights that the inventory in the Southeast has risen by 40%, especially impacting states like Florida, contrasting sharply with California's ongoing home shortages.
What's the status of mortgage rates?
Despite the Fed cutting rates, mortgage applications are at a 30-year low. Current rates hover around 6.2%, making potential buyers hesitant.
How is seller psychology affected?
Sellers may face a tough reality check. As buyer interest wanes, many are realizing their expected prices are unattainable, prompting a shift from hopefulness to pragmatism.
What's happening with real estate investors?
We're witnessing notable sell-offs from both institutional investors and individual landlords, likely leading to broad price corrections.
How do demographic shifts play in?
An aging population likely means more estate sales are forthcoming, potentially flooding the market with inventory as mature sellers may be less price sensitive.
What predictions does Nick make about inventory?
He anticipates that if interest rates decline further, many sidelined sellers might re-enter the market, dramatically increasing inventory levels and further pressuring prices downward.
What might buyer behavior look like in coming months?
Buyer sentiment could shift significantly, leading to prolonged hesitancy as they navigate falling prices and economic uncertainty.
To sum it all up, what are the crucial takeaways?
As inventory swells, changing seller psychology and dwindling buyer demand will effectively shape the housing market's trajectory, paving the way for potential price drops.
And now, onto our next insightful summary.
Up next, dark pool activity goes insane at the peak while Goldman Sachs makes a big call, featuring insights from FX Evolution. You won't want to miss it.
Let's dig into intriguing insights from FX Evolution's latest video, focusing on dark pool activity and market movements.
Indeed, Goldman Sachs has boldly predicted a 6,000 target by the year-end, but we need to examine the market dynamics beneath the surface.
What's the core thesis discussing dark pools?
The primary takeaway suggests that even though market indicators appear bullish, the surging dark pool activity hints at underlying trader caution.
What observations did experts make regarding dark pool activity?
They noted a significant spike, often a sign that traders are worried about potential pullbacks and imminent market shifts.
And what about key resistance levels?
The 250 mark on Tesla is crucial, and with indices like the S&P 500 encountering resistance, traders should brace for possible volatility.
How is market sentiment evolving?
Market sentiment is shifting noticeably, with surveys suggesting investors are moving past AI concerns and beginning to wrestle with recession fears.
What predictions swirl around market performance?
Expectations point towards a potential market pullback in October, a month historically challenging for traders and contributing to the prevailing caution.
Any insights regarding upcoming earnings?
The imminent earnings season is likely to introduce volatility, particularly as significant dark pool trades indicate traders are positioning themselves with caution.
What are the big takeaways from today's summary?
Caution remains dominant in the market with dark pool activity increasing, suggesting traders should prepare for potential dips and closely scrutinize resistance levels.
Any final insights on what traders need to watch?
As earnings season approaches, traders must remain vigilant, keeping an eye on dark pool activities as signals for potential market shifts.
But wait, there's more. Up next, we'll dive into insights from Jim Bullard. On ex-Fed President Jim Bullard reveals what the Fed should do next, how FOMC decisions are made.
You won't want to miss what Jim Bullard has to share about these crucial economic decisions.
Now, we turn to an engaging discussion with former Fed President Jim Bullard, exploring his insights on Fed policy rates and the health of the economy.
Absolutely. Bullard offers a critical outlook on the Federal Reserve's recent decisions and their implications for inflation and unemployment rates.
What's Bullard's core thesis concerning the Fed's approach to the economy?
He contends that the Fed's current policy rates are excessive, indicating that we might not return to the low rates seen during 2009 to 2019, cautioning about its effects on inflation and growth.
Bullard claims the current interest rates are too high. What impact does this have?
He believes we're transitioning toward a more stable rate environment reminiscent of pre-pandemic years.
What does Bullard think about GDP and inflation forecasts?
He remains optimistic about GDP growth, feeling current estimates are conservative, aligning with a sustainable inflation goal.
How does the Fed determine monetary policies?
Decisions are influenced by diverse perspectives, ensuring robustness in policy formulation. Bullard emphasizes readiness for smooth meetings.
What predictions does Bullard hold regarding the economy's trajectory?
He predicts inflation might stabilize faster than anticipated, potentially affecting the job market and leading to economic adjustments.
Are there foreign factors we should monitor?
Absolutely. Bullard identifies geopolitical risks as significant influences on economic health, suggesting unexpected events could unsettle the market.
In summary, what key takeaway emerges from Bullard's insights?
Bullard underscores the necessity for the Fed to adapt strategies to evolving inflation and global uncertainties, navigating new economic waters.
But hold on, there's more. Coming up next, we explore the real reason the Fed's rate cut was a mistake with Bill Fleckenstein.
You won't want to miss the intriguing points Bill brings to the table regarding inflation and market expectations.
Next, our insightful summary dives into Bill Fleckenstein's arguments on why the Fed's recent rate cut is more than just a minor blunder.
Absolutely. Bill, a seasoned investor with decades of experience, critiques the Fed's understanding of inflation and monetary policy. His insights are crucial for grasping the current economic tides.
What's the main thesis here? Why does Bill see the Fed's actions as misguided?
Fleckenstein argues that the central bank ignores historical financial trends and inflation risks. By cutting rates so aggressively, they're overlooking the broader implications of asset inflation.
Let's break down the key points. Is the rate cut a strategic error?
Absolutely. Bill criticizes the cut as a miscalculation of the economy's state, noting that lower rates won't effectively revive a faltering economy.
How does Fleckenstein assess the Fed's grasp of inflation?
He critiques their narrow focus, emphasizing overshadowing asset inflation's far-reaching impacts, often neglected in broader market sentiment.
What looming disconnect does Bill suggest exists for investors?
If investors lose confidence in the Fed, rising yields could signify negative market responses to the central bank's moves, ringing caution.
What does Bill foresee for the economy's future?
He anticipates potential stagflation, stagnant growth alongside rising inflation, presenting a highly volatile economic environment.
How about the bond markets?
Should the Fed cut rates again and bond prices react negatively, we may witness yields rising, reflecting diminishing trust in the Fed's policies.
To wrap it all up, what do we take away from Bill's insights?
Fleckenstein's crucial takeaway is that the Fed's current policies could lead to dire economic consequences. Without understanding historical lessons, they're navigating into troubled waters.
Bill emphasizes the role of financial education. What's his final take?
Understanding financial history is crucial for investors. It's not just about current policies. It's about learning from the past to make better decisions.
If these insights resonate with you, remember to subscribe for more of this valuable content.
Your support helps us continue to bring you expert perspectives and deepen our understanding of the financial landscape.
You've just heard from our financial experts about the intricacies of today's economic landscape.
Indeed, Bill Fleckenstein raised alarms over the Fed's rate cuts, while Snider highlighted how these issues magnify globally, especially from Europe's side.
Jim Bullard, however, seems to hold a contrary viewpoint, emphasizing the need for careful navigation of policy despite the challenges.
It's a fascinating yet concerning dialogue showcasing the spectrum of viewpoints on monetary policy and its implications.
And remember, understanding these nuances is vital for your investment strategy.
If you found this discussion valuable, please like and subscribe to our channel to stay informed with upcoming content.
Thank you for tuning in today. Explore more of our videos for further insights and make sure to keep your investment knowledge sharp.
See you next time on Financial Insights in Minutes.